Welcome to Chapter 10, where we explore exchange-traded funds, ETFs, index funds, exchange-traded notes, ETNs, and exchange-traded products, ETPs. These investment vehicles have revolutionized modern investing by offering diversification, flexibility, and cost efficiency. This enhanced chapter provides a detailed understanding of their definitions, benefits, risks, key metrics for evaluation, and strategies for incorporating them into a diversified portfolio. Additionally, we include practical examples, emerging trends in the ETP market, a hypothetical case study for actionable insights, advanced portfolio evaluation metrics, like Sharpe ratio and alpha, and interactive tools to make the content more engaging. 1. Introduction to ETFs and Index Funds. What are ETFs? Exchange-traded funds, ETFs, are investment funds that hold a collection of assets such as stocks, bonds, or commodities. They trade on stock exchanges like individual stocks, but offer the diversification benefits of mutual funds. Key benefits of ETFs. Diversification. Gain exposure to a broad set of assets in one purchase. Liquidity. Trade throughout the day at market prices. Cost efficiency. Generally lower expense ratios than mutual funds. However, specialized or actively managed ETFs may have higher fees. Transparency. Daily disclosure of holdings. Tax efficiency. In-kind redemption mechanisms reduce capital gains taxes. Example: the Vanguard Total Stock Market ETF, VTI, provides exposure to the entire U.S. stock market. What are index funds? Index funds are mutual funds or ETFs designed to track specific market indices, like the S&P 500 or NASDAQ Composite. They aim to replicate the performance of their benchmark index. Key benefits of index funds. Low fees. Passive management typically results in lower fees. Broad market exposure. Instant diversification by mirroring index holdings. Simplicity. A hands-off approach for investors seeking market-aligned returns. Example: the SPDR S&P 500 ETF Trust, SPY, tracks the S&P 500 index, offering exposure to 500 leading U.S. companies. 2. Understanding ETNs. What are ETNs? Exchange-traded notes, ETNs, are senior unsecured debt securities issued by financial institutions. Unlike ETFs, ETNs do not hold underlying assets. Instead, they promise to pay returns based on the performance of a specific index or benchmark minus fees upon maturity. Key features of ETNs. 1. Debt instrument. ETNs are structured as bonds, but do not pay periodic interest. 2. Benchmark tracking. Returns are tied to an index or asset class, without owning the underlying assets. 3. Credit risk. Investors rely on the issuer's creditworthiness. If the issuer defaults, investors may lose their principal. 4. No tracking error. Unlike ETFs, ETNs perfectly replicate index returns because they do not involve physical asset ownership. Example: the iPath S&P 500 VIX Short-Term Futures ETN, VXX, tracks volatility in the stock market, but does not own futures contracts directly. 3. What are ETPs? Exchange-traded products, ETPs, are a broad category of financial instruments traded on exchanges throughout the day, similar to stocks. ETPs include ETFs, ETNs, and exchange-traded commodities, etc. Key features of ETPs. 1. Diverse asset exposure. ETPs provide access to equities, bonds, commodities, currencies, and more. 2. Intraday trading. Prices fluctuate throughout the trading day based on supply and demand. 3. Cost efficiency. Generally lower fees compared to mutual funds, but can vary depending on product type. 4. Transparency and liquidity. ETP holdings are disclosed regularly and can be easily traded on exchanges. Example: SPDR Gold Shares, GLD, is an etc. offering exposure to gold prices without requiring physical ownership. 4. Leading providers and their strategies. The ETF market includes several well-known providers, catering to diverse investment goals. iShares by BlackRock offers over 400 ETFs covering equities, bonds, and commodities globally. Example product: iShares Core S&P 500 ETF, IVV, which provides low-cost exposure to large-cap U.S. equities. Vanguard is renowned for its low-cost index funds that focus on broad market exposure. Example product: Vanguard Total Stock Market ETF, VTI, which tracks the CRSP US Total Market Index. Charles Schwab's ETFs are known for ultra-low expense ratios and simplicity. Example product: Schwab Total Stock Market Index Fund, SWTSX, which offers broad market exposure at minimal cost. State Street Global Advisors is famous for its SPDR ETFs, catering to both broad market and sector-specific needs. Example product: SPDR Gold Trust, GLD, which provides cost-effective exposure to gold prices without physical ownership. ProShares specializes in leveraged and inverse ETFs designed for short-term trading strategies. Example product: ProShares Ultra Pro QQQ, TQQQ, which offers 3x daily leveraged exposure to the NASDAQ 100 index. Cautionary note: leveraged products are unsuitable for long-term holding due to compounding effects over time. 5. Comprehensive analysis of risks. While ETFs and ETNs offer many benefits, understanding their risks is critical for informed investing. Liquidity risk in niche ETFs. Liquidity risk arises when investors cannot buy or sell an ETF quickly at a fair price due to low trading volume. Niche market ETFs often have wider bid-ask spreads during volatile markets. Mitigation. Focus on highly liquid products with high average daily trading volumes. Issuer credit risk in ETNs. ETNs carry credit risk because they are unsecured debt obligations issued by financial institutions. If the issuer defaults, investors may lose their principal investment, regardless of how well the underlying index performs. Mitigation. Assess issuer credit ratings before investing in ETNs. 6. Emerging trends in the ETP landscape. ESG-focused funds. In 2024, ESG funds saw inflows of $10.4 billion in Q3, despite slowing growth compared to prior years. Median returns for sustainable equity funds were 5.2%, outperforming traditional equity funds during volatile markets. Actionable advice for investors: look for third-party certifications. Reputable organizations like MSCI provide ESG ratings that assess companies' environmental, social, and governance practices. This helps investors avoid greenwashing, where funds may be marketed as sustainable, without genuine commitment. Thematic funds focus on high-growth sectors like AI or renewable energy. Assets doubled over 5 years to $562 billion by mid-2024. However, only 18% outperformed benchmarks, due to high fees and sector-specific risks. Actionable advice for investors. Alignment with long-term goals. The allure of high-growth sectors can be tempting. However, investors should ensure that thematic funds align with their long-term investment objectives, rather than chasing short-lived trends. Direct indexing allows investors to replicate indices by purchasing individual securities, offers customization opportunities, like excluding certain sectors for ESG alignment. Semi-transparent ETFs shield active managers' strategies, while allowing intraday tradability. Example product: T. Rowe Price Blue Chip Growth ETF, TCHP. 7. Portfolio allocation complexity. To evaluate portfolio performance effectively, Sharpe ratio measures risk-adjusted returns. Sharpe ratio equals portfolio return, risk-free rate, standard deviation. Example: if a portfolio returns 10%, with a risk-free rate of 2%, and a standard deviation of 8%, the Sharpe ratio is 10 to 2/8 equals 1. Alpha measures active performance relative to benchmarks. Alpha equals actual return, risk-free rate, plus beta times market return, risk-free rate. Example: if a portfolio returns 12%, while the expected return based on market performance is 10%, alpha is 12 to 10 equals plus 2%. 8. Case study: building a $100,000 portfolio. Allocation: 1. Core holdings, broad market ETFs, 50%. SPY, $30,000. VEO, $20,000. 2. Sector-specific, thematic ETFs, 20%. ICLN, $10,000. XLK, $10,000. 3. Fixed income, bond ETFs, 25%. AGG, $25,000. 4. Alternative assets, commodities/real estate, 5%. GLD, $5,000. Conclusion: ETFs, index funds, ETNs, and ETPs provide flexible tools for achieving portfolio objectives, while balancing risk and return potential. By leveraging emerging trends like ESG-focused investing or thematic funds, and utilizing interactive tools like portfolio simulators, investors can construct diversified portfolios tailored to their goals, while using metrics like Sharpe ratio and alpha for evaluation in an ever-evolving investment landscape.